Welcome everybody, and thanks for joining us for today's Total Return webcast. Here we are, only a month away from the Masters golf tournament. It's amazing how the years file by so quickly, especially when you get to be old. So this is entitled Not in My Neighborhood. I almost entitled it In My Neighborhood because the picture on the screen is one of the streets in the Palisades. And people often think that they're immune or exempt from ramifications of various aspects of their life. That happens with nobody thinks they're going to have a wildfire in their backyard that's going to burn down something like 6,000, 7,000 structures in a very concentrated neighborhood. But also, the idea here is there's investment themes that we're going to be exploring about diversification away from all U.S. only investments, which I've been talking about really somewhat frequently for the past 3 years or so, but it seems like the moment is at hand, and we're going to be talking about that. DOGE also reminds me of a not in my neighborhood thing. A lot of people don't like the waste and corruption in the federal government, but once someone starts to actually cut things, people they don't want their aspects to get cut. So it's sort of like you can't cut without cutting. So you have to find the fraud and the waste and the corruption, and you actually have to cut it. And I'm quite in favor of that happening because it's the only way that we can try to get our fiscal house in order. I would also say that that Mag 7, the momentum stocks, in particular the Mag 7, they are viewed to be invulnerable and immortal in terms of nonstop outperformance, but that never works that way. Every sector is always vulnerable, and we're starting to obviously see that. Well, let me get going with the slide presentation here. This is where we started 2025. This is actually the end of 2024, December 27th. And we entered 2025 with a grossly overvalued risk market, particularly the equity market. We see this is broken into three sections. On the left is U.S. equities. And on the x-axis is when the data series starts, the date on the data series. And we're comparing the valuation as of December 27th, 2024 to the time period from the beginning date on the x-axis until today. So for example, the S&P 500 median forward PE was up there at like the 98th percentile, so rarely any richer. It reminded me very much of year-end 2021. When I talked about how overvalued things were. And of course, 2022 was a disastrous market for both stocks and bonds in the United States. But you'll notice that, I won't go through all the categories, but you'll see that except for the smaller cap stuff, we really had top decile types of overvaluation entering 2025. Non-U.S. equities in the middle, a little bit cheaper. I wouldn't say anything except China, really, and emerging markets. And maybe the KBW regional banks, everything else is above average. And there's nothing really super cheap on this valuation in the non-U.S. equity market as of year end. Then we see fixed income where there's a spectrum. We see that the corporate bond spreads were almost the tightest of all time. The same thing was true of corporate bonds in general. And then we see as you get into junk bonds that are lower rated, not quite as rich versus their history going back to 1990s and so forth. And then we see that CMBS clearly screening cheapest on the valuation relative to its history going back to 1997. So that was the setup entering the year. So what has happened through March 7th, this is on here. Of course, some of these have gotten worse since then. But we see that the Dow Jones is the top performing of the standard indices for stocks. It was up a little bit. Of course, that's not the case now. S&P 500 was down 1.6. Then we see the NASDAQ down over 5. Of course, these losses are much worse after the past several days. And then we see the Russell 2000 even worse. And then we see the non-U.S. equities. The world equities actually a small gain, but the eurozone up 12.4%. So a really unusually high outperformance based on recent history. And we also see the FTSE doing well, up 9.6. You see the Nikkei gave back a little bit. And then we go into fixed income, which has outperformed the major equity indices, and that gap has clearly widened. I think the aggregate index is outperformed the NASDAQ through today by about 12 percentage points, with the bonds all basically being up. Just a question of where you stand, and the worst performer is floating rate, because we have had an interest rate decline, and so floating rate has not been helpful because you don't get the same price gains from falling intermediate term interest rates. We see the dollar's been weak this year, down 4.3% on the Dixie index, and so that's partially what's fueling the Euro stocks doing so well relative to the United States equity market. And this is something I've been talking about for about 3 years, maybe even longer than that European equities would start to outperform once we had a downtrend in the dollar, which appears to be in place. We see obviously the euro up, the yen up, all these other currencies are up versus the dollar. And then we see that the energy complex is down a lot, 6%. Oil is down. That's one of the goals of the administration. We'll see if that continues. And we see the commodity markets broadly up 5.7 on the Bloomberg commodity and 1.2 on the Goldman commodity index. And the big winners are the metals. The gold and copper and industrial metals are all up, but copper a big gainer, but gold continues its bull market that we've been talking about really now for a couple of years, ever since gold was down to 1,800 and now it's flirting with 3,000. I see a lot of funny forecasts that people say gold's going to 3,000, which is not much of a forecast when you're starting out at 2,900 and change. That's a forecast when you're 1,800, not when you're at 2,900 and change. I'd be so bold to say is I think gold will make it to 4,000. I'm not sure that'll happen this year, but I feel like that's the measured move anticipated by the long consolidation at around 1,800 on gold. So mixed bag here with some real ups and some real downs for the year through March 7th. We're going to put the Bloomberg Aggregate Bond Index in context of its performance. There's 49 years worth of aggregate index performance, and this year is the black line that's thicker than the other lines, and we can see that we're number 5 out of 49 years. So it's a top decile year so far on index fund performance. Point out 2022 on here, just how completely out of the context that year was. Back 30 years ago, we thought 1994 was a bad year because it was negative a little bit, but we see that 2022 is just off the charts versus other experiences. Here's history of drawdowns in the aggregate index. And since we're in a bull market secularly from the 80s into 2022 or so, 2021, we see that the drawdowns didn't last very long because you went to new highs with falling interest rates on a secular basis. So what we say that the drawdown that began August 2020, I don't know if that will ever be taken out. We probably need years of new issuance of bonds and economic rotation. But right now we're at 55 months since the peak in the aggregate index price, and the drawdown is still 17.2%. So a pretty massive drawdown on price. This is the 30-year Treasury bond, the one with the longest duration, and we see that it is still 48% below its peak price back in, I'm going to guess it was August of 2020, just like the index broadly. So still huge losses in Treasury bonds from the peak coming on. It's going to be about 5 years ago soon. Here is our yields going back 10 years. In the upper left, we see the 2-year Treasury yield, which went up pretty sharply with the Fed raising rates ultimately 500 basis points, 525 basis points, I think it was. And we see that the 2-year topped out a couple of years ago and is now sitting just at about 4%. The 5-year Treasury is not much higher at 4.09. It's a very similar pattern to the 2-year. The 10-year in the lower left, very similar pattern. So we're seeing that we have not gone to a new interest rate high in a couple of years, a couple of years plus. Then we see the 30-year, same pattern. So this looks like it's been a move consistent across the yield curve, but there have been moments of inversion and now we're at a fairly de-inverted yield curve once again. We used to use the copper-gold ratio. It stopped working once the secular declining interest rate world of disinflation was replaced by a rising secular interest rate world, which is what I think we're in now for the Treasury bond market. So I've been looking for things that are working in recent years, and one that is obviously a strong correlation is on the screen now: crude oil, which is the kind of the tan line, and the blue line, the 10-year U.S. Treasury yield. It really looks, except for that one exception in kind of the fourth quarter of 2024, it kind of looks like it's the same line. And right now, it suggests, these don't line up perfectly, but it suggests that yields remain high relative to crude oil, which has dropped a long way in price, down from 80 about a year ago down to 67 or even lower than that today. Something else that correlates very highly is the U.S. dollar. This one's almost really does line up. It really is almost exactly the same line. And this one also suggests, the dollar index is the tan line, it suggests that the 10-year Treasury yield could have room to fall further. I guess that would require more economic angst and perhaps some real recession risk that the administration is sort of admitting that they don't care that much about the stock market like they did in the first term of Trump, and they're more interested in really just getting through a transitional phase in the economy. Last time I heard the phrase transitional had to do with the inflation in 2022, with the Fed calling it transitional or transitory. So we'll see if this is really an economic transition or not. So that's the status of the 10-year Treasury yield. As I said, the curve was inverted there for a while and now has de-inverted, so it's now steeped. 2s, 10s is now up at 33 basis points. It had been negative 108, so it's been a pretty meaningful steepening of the yield curve. The red shaded areas are recession. Typically, when the curve de-inverts, you would expect a recession. Now, that didn't happen, at least not officially so far. But if you look at the blue line, the smooth line, which is the 12-month moving average, it has not gone yet above zero, although it's getting awfully close. And if you look at those recessionary bars, it looks like the real definitive moment is when the 12-month moving average crosses above the zero line. That should be happening fairly soon. So it looks like the inflation, the odds of recession are going up. We saw economists had lowered them to about 20% chance of a recession this year. And now I hear some people raising their estimates to 30%, 40%. I would say we're more at a 60% chance of a recession in 2025. So this chart kind of supports the thinking behind that. Here's Fed funds and the 12-month hike cut expectations by the Fed. And so we see that the Fed was way out of line down at the bottom panel before they started cutting rates in September. You see the tan line of the Fed funds target was very different from the hike cut expectations. And it was also way different from the 2-year Treasury, which is kind of the same thing as the hike cut expectations. And the Fed, by cutting rates 100 basis points, has gotten more in line with the hike cut expectations. And the 2-year Treasury now is about 3.9%. So maybe the Fed will cut rates once, maybe 1.5 times this year. In recent days, the market has refigured that the Fed might cut rates more than 2 times this year. I'm sort of skeptical of that, but we'll have to see how the data develops. This is how the market pricing of Fed cuts in 2025 has been gyrating. We take this back to year-end 2023. We see that for much of the year, through the first 9 months, there was a lot of cuts being priced in, and we got a lot of those starting in September, and a lot of those started to get priced out. And now more recently, in the last month, we're seeing cuts being priced back in. So it's been a roller coaster ride of about 1 cut down to about 8 cuts, and then back to 1 cut, and now it's coming back to more cuts. So this continues to gyrate. Here's the 2s 10 curve and the U3, the headline unemployment rate. And we see that the movement in the yield curve, the 2s 10s spread, suggests that the unemployment rate should be going up. It started to do that and then slowed down. So is kind of signaling further deterioration in the employment picture. And certainly DOGE, if they do cut jobs and waste from the government, there could be a very significant effect on the unemployment rate going higher. We'll see if that matters because it's the unemployment rate, or because it matters less because it's a targeted subsector of the economy. We'll see what happens with that. Here's the one that is still signaling recession. This is the unemployment rate versus its 36-month moving average. And again, it looked like it was going higher, and then it stalled out. The moments in time that were most common to this one were back in the other peaks of risk assets, back in 2000 and back in 2007, 2008. This one is flattened out a little bit more than those periods, but we haven't gone on that huge acceleration yet, at least, that we saw in the aftermath of the 2007 experience. I'm going to go to some economic charts that show some real change just on a year-to-date basis. The first is on the screen now. The Conference Board expectations for fewer jobs in 6 months has just gone straight up. Maybe this has something to do with the DOGE agency, but is taken out the prior peaks going all the way back 10 years and further. And we haven't seen an experience of it going up this much this quickly since about 2010, 2011. And that's when the people were talking about the credit rating of the United States being at risk, and we were talking about government shutdowns, and there was a partial downgrade of Treasury debt by one of the rating agencies, which I thought was silly and still do. But we didn't get a recession at that last spike, so we'll see what happens this time. But this is a really big shift in a short period of time. And here's the forecast from GDP Now, from the Atlanta Fed, which was clipping along at a 2.5 sort of a range. And you'll notice that the blue chip economists were in agreement with GDP Now earlier this year. And then all of a sudden, with this tariff saber rattling going on, we see that we see tremendous economic distortions, and one of them is real GDP for the first quarter, which is now estimated by the Atlanta Fed to be negative 2.5. We haven't seen a number like that in a long, long time. I don't know exactly why this has changed so radically on one day. That big downgrade to about negative 1.5% happened in a day. So we're going to be following this quite closely. Here is something else this is also a disturbing trend, but one that's not new. This is federal deficits by fiscal year, and the fiscal year starts in October. And you'll notice that sequentially every year we are getting further into the deficit problem with fiscal deficits going up. So 2021 was bad, 2022 was worse, 2023 was, when it came to the fullness of the year, the worst ever, and 2024 is off to a very troubling start. So hopefully we get somewhere with cutting some of these, many appear to be fraudulent programs that the government seems to be totally willing to put in place and keep in place, and we'd like to see those go away, of course. It appears that the level of misallocation of government funds is very hard to overestimate. Here is the monthly coupon issuance by the Treasury Department going back to 2007. And this is kind of interesting. You'll notice that the massive mountain of issuance in response to COVID, with all of that money printing, has been matched with the mountain of borrowing that we've had in the last year. And so will this go to a new record? I certainly hope not. But it's really distressing that in what's perceived to be a growing economy, that the amount of debt is the same as the most spectacular response from a fiscal stimulus and a money printing situation. We're at the same amount of debt now being issued as we had during all of that $7 trillion of money printing. This is a chart I haven't ever used before, but I think it's really interesting. What we have is the budget deficit versus the unemployment rate. And so the budget deficit as a percent of GDP is on the y-axis, and employment rates on the x-axis. You can see that the trend from 1960 to 2017, so that's the trend line through the black dots, was pretty understandable. When you had a high unemployment rate, you had a high deficit to fight it. And when you had a low unemployment rate, you had a low deficit relativistically, or even no deficit for some of those years, and a surplus instead. But now look what's happened 2016 through 2024. what we see is that the unemployment rate is at the left-hand side of the x-axis, but the budget deficit is at at the bottom, near the bottom. So the highest, since it's inverted, one of the highest percentages of GDP, running at 7.2%, and we haven't had a recession yet. So I know I talk about the deficit a lot. I'm not going to dwell on it a lot this time. I'm anxious to see if we can actually address the budget deficit. I had a question in the queue, which was almost like, when did you stop beating your wife question? Someone said, do you still support everything the Trump administration does? Well, I never supported everything the Trump administration did. I didn't like the state and local tax deduction cap. I didn't like the tax cuts that Trump put in place. I don't like a lot of things that every administration does. So we'll see what happens. I do support the DOGE thing. I would like to find at least $1.5 trillion of cuts. We'll see if we can find that. It seems like a large, pretty heavy lift. Here's the headline in core CPI. We're going to talk about inflation now. This is one of the things that's troubling the Fed is the progress on inflation. They keep saying we're making progress in the press conferences. We'll see what happens next week. But we're not really making progress. The core inflation rate is far above the 2.0 target. It's at 3.3 on the CPI. And the headline is at 3.0, and that is actually up in the most recent reading. Here's core producer CPI. This is actually producer price indices, and they're even less cooperative for the Fed. We see that the final demand, which got near zero, is now rising sharply. It's up 3.5% year over year. And the final demand, less food and energy, the core stuff, is about the same. It's not rising at the same pace, but it didn't get as far down since it's not as volatile. The next slide, I think, is the most troubling for the Fed, and that is the month-over-month changes in the CPI. So the top panel is the headline, and it's not only going up every month, but you can see it's almost monotonic. It's been like 8 months in a row that the month is equal to or higher than the month before, and the most recent month is 0.5. So that annualizes to a number far above the 2% target, and food is rising more in most recent months than in the month prior in the middle panel. And then we see energy is much better contained, except not for the last couple of months. So I think it's that top panel that's troubling the Fed. Here's core CPI, same thing. And the most recent reading was really bad. The core reading at 0.45. The number comes out tomorrow. It's expected to be better than that, the 0.45, but we'll see what happens. You can see that the core CPI has really stopped declining on a month-over-month basis. We see used cars and trucks are on there. They're back to rising after a period of payback from the big pandemic price increases. And then we see owner's equivalent rent is gradualistically slowing down. That should probably continue, perhaps not in the Huntington Palisades, where surprisingly home prices are being at least quoted or being offered at pretty high prices, in spite of the fact that the area has a lot of work to do to get back to where it was. Here's Supercore. Nobody talks about this anymore, and I guess the Fed mothballed this because it wasn't cooperating. Supercore taking out its Supercore services X housing now, so no food, no energy, no housing, which is doesn't leave much for most people's lifestyles in terms of what they have to purchase. But we see that it was 0.76 in the most recent month, which is just a horrifying type. It's like a Jimmy Carter type of number. And then we see medical services have eased, and we see motor vehicle insurance continues to be horrible with a 2% monthly increase. So these insurance prices have gone up by something like, 160% in the past couple of 3 years. Here's the one I like, which is not cooperating so much anymore, export-import prices year over year. These don't have any of those seasonal adjustments or any kind of hedonics or anything. And they were very inflationary, then a payback during 23 and into 2024, but now they're back to rising again, and we see export prices are up 2.7, import prices up 1.9, and this is without implementation of more tariffs. So I guess I would expect these prices to start going up depending upon how this tariff saga unfolds. I mean, it changes seemingly by the hour, on again, off again, and it doesn't seem to have a strong logic to it at this point. I know that Trump likes to negotiate in public and says things he doesn't really mean, like Canada's going to be the 51st state. I don't really think he believes that, but he likes to troll people, I guess. And here's the one-year break even, which is sort of shocking. I have a hard time seeing how the Fed could cut rates with the one-year break even from the bond market at 4.0%. So these are some of the highest shorter-term inflation indications that we've had, really going back to I don't know, I guess it was this time a year ago. And then we have this shocker out of the University of Michigan, consumer inflation expectations, which have shot up again, and this matches that one-year break even at about 4.3. So inflation expectations, I guess people, maybe they think that tariffs are going to do this, and maybe they will, but this is troubling for the Fed and for this idea that we're going to get the interest rate down anytime soon. Here's the Bloomberg Commodity Index, which has shown some signs of life recently, primarily, as we saw earlier, because of copper and gold in the commodity complex, certainly not because of energy, but it's above its now rising gently 200-day moving average. So commodities are no longer falling on an aggregated basis and are showing some signs of life. This is not good for the inflation outlook, obviously. And here's gold up at 29.05. That was on March 7th. It's almost exactly there again today. You can see what I mean by that consolidation period down there at 1,800, and then finally it broke above 2,000. And when it broke above 2,000, you kind of expect the move to be almost as tall as the consolidation period is wide. And to my eye, that suggests higher than 3,000 and perhaps headed to as high as 4,000. We'll see what happens. This is one of the reasons why gold is so strong. The IMF World Reserves gold holdings, so central banks sort of holding gold, has just skyrocketed from 2010 down. I know the scale isn't huge here, but it was down at 34 billion to up to 41 billion, but it's done so in a very sharp, steep trajectory, and I don't expect this to stop. And so we've seen the characteristic of gold changing, with central banks who are disinvesting now significantly going back to their investment position. And I think that that's in recognition of gold as a storehouse of value that's more outside of the financial system, which seems to be in a state of flux at this point in time. Here's the U.S. trade balance of goods, and this has something to do with tariff anticipation, I'm sure. But we see that the U.S. trade balance went to negative 156 billion in the most recent month, far taking out even the COVID period massive increase in the trade deficit. So now we're up at $156 billion. I mean, this has a lot to do with the theme, not in my neighborhood here. It seems that something is going on with central bank behavior, which has something to do with geopolitics, which will ultimately, we believe, have something to do with fund flows potentially changing, and that's going to be a very potential disruption to the so-called U.S. exceptionalism, which I just call U.S. outperformance on the financial markets that we saw, and we're going to take a look at this in just a few minutes, that appears to have definitively reversed. This is the average tariff rates on U.S. imports, and this goes back to 1930, and we see that tariffs used to be a lot higher than they were in recent decades, going back to 1950. And now with Trump, it looks like maybe they're going back up. So we saw a tremendous amount of tariffs in past years, but this is average rate on durable imports is the gold, average rate on all imports is the blue, and then we go, the Trump dot is on there. Here's who our trading partners are, our exports to the United States as a share of that country's exports in total. And we see Mexico has 80% of its total exports go to the United States. Canada, almost the same, up in the high 70s. And then there's a gigantic fall off down to Japan at 20. So this is why there's so much noise between the United States and Mexico and Canada, and why it's such a big issue, because they're very large trading partners. And I understand the thesis behind Trump's tariffs when he talks about reciprocal, because it does seem strange that we have higher tariffs put on stuff that we import than the stuff that we export is put on to these other countries. So there is something that's going to happen here, and it certainly appears with market action so far to be largely disruptive to some of the things that people thought were forever trends. That nothing bad could ever happen because nothing bad will ever happen in your neighborhood. Well, trust me, yes it can. I know that from January 9th when my house caught fire. Thankfully, it's all exterior or landscape damage, nothing in the house, thankfully, but still a lot of work and expense to clean it up. So this is spreads across fixed income sectors, getting into the specifics of the bond market now. And what we see here is the yellow diamonds or rhombuses are as of December 2024, and then we have currently, which is yesterday. And so we see that spreads have been kind of the same on some sectors. We see triple C's have come in a little bit in the leveraged loan market, it looks like, and in a little bit in the high yield market. We see triple B's rather, in CMBS have come in a little bit, but spreads haven't changed all that much on a year-to-date basis. First, they tightened, which is common at the outset of a new year, but with the Treasury rally that we've seen in recent weeks, many of these sectors have given back their spread tightening. For example, the high yield bond market got as low as 252 versus the Treasury market yield, index yield, and now it's gone above 300. So there's about a 50 basis point widening in high yield. It's not so much that high yield has been weak as in falling prices. It's basically that the high yield market has not been able to keep up with price gains in the Treasury market. In fact, in many parts of the credit market, there really aren't any price gains, but they're just sort of treading water in terms of price. Here's the corporate high yield differential between the junky stuff, the triple C's, and the safest stuff in the letter rating double B. And we see that double B's have widened a little bit, and we see that the C's, the triple C's, is the blue line. The tan line is the moving average. So on average, the triple C's have been coming in, but they still remain relativistically wide versus some past time periods on a moving average basis. Defaults have started to pick up in the high yield market and certainly in the loan market. We see the high yield market's at 2.8. That's not a high default rate, but it has reversed from a declining default rate, and it's now on the climb again. And then we see loans are at a new local high for the default rate. That's not surprising because the Fed still has rates up 425 basis points from where they were at the bottom in the cycle. And so these companies in the floating rate market, they are still paying over 4 percentage points higher than they did a few years ago. And that takes its toll as time passes and more bonds get reset at higher levels. And then we see the recovery rates for those defaulted bonds. The high yield sort of hanging out, senior secured, hanging out at 42 cents on a recovery rate. That's not a very good recovery rate, but it has not been much better than that at any time since 2017, where you got about 60 cents. And then we see the first lien loans at 62 cents on the dollar recovery rates, which are fairly constant over the last multiple years. Here's the non-agency CMBS market. We can see that the AAAs are all the way back to where they were pre-pandemic. We see the AAs made it almost all the way back and have widened a little bit. That's the same phenomena as we see in the high yield market. It's not like CMBS is really going down in price, but it's not keeping not quite keeping its pace with Treasuries, given the shorter duration too. And then we see that the triple B minuses in the CMBS market, they never made it anywhere close back to the pre-pandemic level. So they have risen a little bit recently, but there was some pretty mighty spread tightening during the second half of 2023 into the start of 2025, from about 900 basis points to more like 400 basis points. So, but these are all, just like most spreads in the non-Treasury market, rising a little bit. Here's the S&P 500, which was way above its 200-day moving average when it was so overvalued, the first slide in this exhibit to end 2024. And we've made it all the way back to the 200-day moving average, and now it's below. This was as of yesterday, and while it looked like the S&P 500 might make it into the green on the close today, that didn't happen. It had a minor loss today, so we're now below the 200-day moving average on the S&P 500. So it still appears to have some momentum on the downside. And here was, of course, the big problem. The top 5 companies in the S&P 500 is a percentage, of the market cap. And so the top 5 companies, Apple, Microsoft, Nvidia, Alphabet, and Amazon, we went from back in 2020 or so, we started out at around 17%, and we got up to 28%. And if you add a couple more companies in there, you're starting to get, if you're invested in an index fund in the S&P 500 at the end of 2024, you weren't very diversified. You had 7 companies that were representing almost half of your entire portfolio. This is why I've been recommending, I did it in year end and I did it in the Just Markets webcast. I recommend, and we did it in the Roundtable Prime as well, recommending equal weighted ownership of U.S. equities or the S&P 500. And we say that the market cap is definitely hurting now because the high flyers are not immune from the consequences of the high market valuations. They ultimately fall into line and suffer the consequences of their incredible relative strength that was in place in the last couple of years. So here's the progress on equal weighted versus cap weighted, and we see a huge round trip. So this was the same concentration as we saw in the global financial crisis. Then there was a lot of financials that were top heavyweights in the S&P 500, and then it went all the way down to 0.625, and then it went all the way back up to a double top, back to the global financial crisis levels. And it's not convincingly yet, but it appears that it may have broken down. So far, short period of time, equal weighted is outperforming by several percentage points, at least year to date, the market cap weighted. And here's one of the most remarkable things there is. And this is why I entitled this, for other reasons, but the primary reason, not in my neighborhood. We see U.S. stocks versus the rest of the world going back to 1970s, the Nifty 50 bubble, which is what this kind of feels like. I remember the Nifty 50. I'm old enough to remember that. And that was thought to be an absurd concentration in just 50 stocks in the U.S. stock market. And it went down to a very low level from there, getting cut by, about 80%. And then we see the internet bubble wasn't as bad as the Nifty 50, but look at where we were in U.S. versus global ex-U.S. equities, the blue line. And it was just an outrageous overvaluation. And there was reason to believe, which we'll get to, that the flows that drove this outperformance of the United States are vulnerable to being reversed. And we're going to get to that. But look at the big reversal that we've seen in just since December 24th, 2024. Pretty big reversal, and I believe this is going to continue. So I'm reiterating my recommendation that one invest in European stocks, which I talked about as about 3.5 years ago, and other non-U.S. stocks. Here's equity prices versus the rest of the world on a zooming in to just the last decade or so, and we see the magnitude of this reversal. So we're almost back to 2022 levels, not quite here on the U.S. versus the rest of the world. But here's the United States investment position. So this basically shows net investment into the United States. And so what we have here is investment into the United States from foreigners has gone from about $3 trillion, say, 15 years ago, to $23.6 trillion. And when you have $20 trillion flow net into the United States from foreigners, that obviously drives the market to outperform those foreign markets. But with all of this rancor that's going on with tariffs, and Europe suddenly being, I think one of my portfolio managers called it rug pulled. They got the rug pulled out from them on the U.S. being willing to foot the bill for NATO forever, wanting Europe to start protecting themselves. They feel vulnerable and maybe in the process of reindustrializing. Germany, the UK, other countries in Europe reindustrializing so that they can help be more self-reliant defensively. That would almost invariably mean these flows would reverse, and that could lead to continued, ongoing, perhaps multi-year outperformance, maybe even decade outperformance of non-U.S. stocks versus U.S. stocks. And look what's happened in Europe. This is incredible. So we started investing in Europe for the first time in the history of DoubleLine back in, I think it was around 2021 or so, for the first time in the summer of 2021, and it didn't work at first. Well, it worked a little bit at first, because when the blue line, it didn't work a little bit at first, but then the blue line started to go back up again. That's the U.S. outperforming. And then it looked like Europe was really onto something there in 2022, outperforming. But that was during a bear market. And I always expected that come negative stock movements that the U.S. would underperform. And that happened, and now look at it. We're all the way back to 2021 levels. So if you bought Europe versus the United States in 2021, it was painful for a couple of years from 23 to 25, but now it's got a lot of momentum. And here's the dollar index, which doesn't look like much on this display, but it has had some significant movement to the downside. This is heavy euro oriented. So this is one of the reasons, I think, why European stocks have been able to start outperforming is the dollar has weakened off of its highs of a couple of years ago, and it's moved down several percentage points in just the last few months. Here's the same thing looking at emerging markets. This has been an incredible outperformance by the United States versus the S&P 500 versus emerging market equities. Really remarkable. This goes back 10 years. You could take it back longer than that and the trend would still be monumental, and there was just no reversal other than 2022 during the bear market. Again, further indication that maybe during a negative market the US will underperform and not outperform. That's been my forecast. I think the dollar will go down in the next recession. I think the US market will underperform in the next recession. That's the opposite. Don't tell me that goes against history and that I'm saying this time it's different, because I'm contextualizing this that we do not have a secularly declining interest rate environment. We have a secularly increasing interest rate environment, particularly at the long end. And I believe, as I've stated repeatedly in past webcasts, during the next recession, the dollar will go down and the U.S. will underperform. And 10-year Treasury yields, or certainly 30-year Treasury yields, might go up. And so this is a very different environment, and it's because the context has changed. So emerging markets have even started to outperform, and it didn't take, it was even pre-election by a little bit that emerging markets had started to top out and roll over, but much more recently that has happened. So here's S&P 500 relative performance versus Morgan Stanley EM index. And we've got that plotted against the trade-weighted dollar. So this is not the same as the Dixie. It's the trade-weighted dollar, which is more correlated to emerging markets. It's not so euro-dominated. You can see it's the same line. So what we see here is if the U.S. trade-weighted dollar goes down, which is my expectation on a secular basis, emerging markets should outperform. And the dollar will have to really be convincing, would have to break on this index below about 118 versus the trade weighted, but we started to get some momentum on the downside. So with that, this will conclude the March 11th, 2025 Just Market webcast. It's been an interesting start to the year, and it looks like it's going to be not a carbon copy of 2024. That's for sure. So good luck, everybody. Thanks for your attention today. Thank you for your faith in DoubleLine, your confidence in DoubleLine, and goodbye for now.